Hello and welcome to Healthy Wallet. In today's video we're gonna see 15 dividend stocks to buy for 2023 and to hold for the long term. But before we start, please like this video and subscribe to the channel for weekly updates. 2023 is going to be a crazy year for the stock market. Russia's invasion of Ukraine, a deepening inflation crisis and the Federal Reserve's aggressive interest rate hikes have rattled markets. Stocks rallied sharply at the end of the year on hopes that the Fed would ease into rate hikes. However, the economy now faces a recession in 2023 and geopolitical tensions remain high. Additionally, certain industries, such as real estate, appear to be in deep trouble. So what should investors do? Dividend stocks are still a great bet. Defensive blue chips tend to do well in bear markets and continue to deliver strong returns even during recessions. With that in mind, here are 15 dividend stocks that are well positioned no matter what the economy might do in 2023 and beyond. They all bring returns of at least 3% and offer excellent income prospects from day one. Number 15, Shell plc. Shell is one of Europe's largest integrated oil and gas companies. It is also a pioneer in weaning ourselves off fossil fuels. The company has invested heavily in renewable energy. It is also expanding its network of gas stations, convenience stores, and new electric vehicle charging stations. Shell believes this focus on consumers will enable it to transition to a profitable, carbon-neutral company by 2050. But at the same time, oil, gas, and chemicals continue to generate more than 75% of the company's profits. That had unexpected results this year as energy prices rose. As a result, Shell is well positioned for the next few years. It can generate higher revenues from its existing fossil fuel assets while using the cash flow it generates for electric vehicle charging and other next-generation solutions. Currently, Shell shares offer a whopping 3.5% dividend yield. Number 14, Verizon Communications Incorporated. Verizon is one of the top 3 wireless service providers in the United States. The industry has historically been viewed as a safe haven, but recent events have challenged that notion. Verizon and AT&T Incorporated, T, have both disappointed investors over the past few years. Growth in the industry has slowed after demand surged during the pandemic. Costs remain high due to expensive 5G deployments and expensive radio spectrum purchases. Combine rising costs with a maturing industry, and telecom providers seem less attractive. However, with Verizon selling for just 7.4 times projected 2023 earnings, and analysts expecting the company to return to modest earnings growth in 2024, the bears may be overstating things disproportionately. Meanwhile, the stock has a dividend yield of 6.9% today. The company's weakness has been fully reflected in the stock price. Number 13, Royal Bank of Canada. Royal Bank of Canada is one of the largest banks in Canada. The company operates in a market favorable to banking companies. Canada is dominated by just 6 major banks, which control more than 90% of the industry's total assets. This limited competition results in huge profit margins and long-term stability. RBC has also expanded significantly in the United States, with about a third of its revenue coming from outside Canada. The bank's wealth management and other non-retail banking businesses provide diversification and enhanced returns. Bank of Canada is out of favor in 2022 amid fears of a Canadian housing crash. That could happen, but the Canadian government is providing significant support to the mortgage market and de-risking Canadian banks. Add it all up, and this leading financial institution trades at 11 times forward earnings and has a 4.1% dividend yield. Number 12, International Business Machines Corporation, IBM. Over the years, IBM hasn't looked like one of the best dividend stocks to buy. After all, newer software and cloud companies are thriving, and IBM seems to be lagging behind. The trend reverses in 2022. IBM stock had a total return of 18.2% for the year through December 13th, despite a sharp sell-off in the rest of the technology sector. What explains mood swings? On the one hand, IBM returned to growth after years of declining sales. The company's bold acquisition of Red Hat has energized IBM's cloud business. Meanwhile, the market's newfound focus on immediate earnings and cash flow rather than future growth prospects has brightened IBM's outlook. While IBM is a slow-moving company, its legacy relationships with numerous Fortune 500 companies continue to generate surges in cash flow. The stock, which yields 4.4%, has some upside potential if IBM continues to cannibalize market share among larger cloud computing providers. Number 11, Intel Corporation. 2023 is going to be a dismal year for the semiconductor industry as a whole, and Intel in particular. The 2022 semiconductor shortage quickly turned into a flood. As for Intel, demand for laptops and tablets fell from record highs in 2021 to double-digit year-over-year declines. By 2023, both Intel and Advanced Micro Devices Incorporated, AMD, are likely to be selling chips at the rate they are producing them. However, now inventories are piling up and prices are dropping. The semiconductor gold rush is over, but Intel's economics remain strong. It's much bigger than its competitors and has a huge R&D budget. It sets the stage for the next upswing in the semiconductor market. Meanwhile, the Biden administration's CHIPS Act provides a sizable stimulus package for semiconductor companies such as Intel that build manufacturing facilities at home. With the recent decline in Intel shares, the stock is currently yielding more than 5%. Number 10, Citigroup Incorporated. Citigroup is one of the largest banks in the country. It has extensive retail banking operations and is also engaged in investment banking and has a significant international presence. The bank's reputation has long been challenged. It underperformed during the 2008 financial crisis and has made several questionable decisions since then. However, his assessment today is completely divorced from reality. Shares cost just 6 times earnings, less than half book value. That's despite Citigroup's operating performance soaring due to higher interest rates. Citigroup's return on equity is now the highest since 2006. These factors are starting to catch the attention of high-profile investors. Warren Buffett's Berkshire Hathaway bought a large stake in Citigroup stock in 2022. Given Buffett's exemplary reputation among financial stocks, value investors should keep a close eye on Citigroup and its 4.5% dividend yield. Number 9, Enbridge Incorporated. Enbridge is one of North America's major midstream energy companies. Enbridge's pipeline network originated in Canada and spans nearly the entire continent. Enbridge currently transports approximately 30% of the crude oil produced in North America and processes 20% of the natural gas consumed in the United States. The company also has investments in energy storage, gas utilities, and renewable energy. Ironically, Enbridge is in a strong position thanks to environmentalists and government regulations. Building new pipelines was extremely difficult due to obstacles to further development. This makes existing pipelines more valuable. Enbridge is also a shrewd operator, using his clout wisely without overstretching his balance sheet. That has allowed Enbridge to maintain a steady dividend payment over the past few years, even as many of its U.S. peers have had to cut their payouts. ENB stock currently yields 6.6%. Number 8, 3M Company. 3M is a broadly diversified industrial group. The company is known for consumer brands such as duct tape, sticky notes, and Ace bandages. The product range is wider, from dental equipment to safety helmets and auto parts. The company has been awarded more than 118,000 global patents and remains an innovation leader. Still, 3M stock has struggled in recent years amid a weak economy and various product liability lawsuits. That has pushed 3M shares to their lowest level since 2014. However, the company continues to increase its dividend every year, yielding a whopping 4.7%. It's not just the dividend that's propping up 3M's stock price. The stock currently trades at just 12 times forward earnings. That's well below 3M's historical median. Morningstar's Joshua Aguilar puts the fair value at $183 per share, up about 44% from its December 13 closing price of $127.29. Number 7, U.S. Bancorp Incorporated. U.S. Bancorp is one of the largest banks in the United States and primarily focuses on retail banking. In the past, this has been an advantage, with the U.S. having Bancorp bringing much higher than average profitability. However, the past decade hasn't been particularly good for the company's business model, and its stock has outperformed the S&P 500 and its peers in recent years. This should change in the future. On the one hand, the American Bancorp has just finalized the long-planned takeover of Union Bank, which it acquired from Mitsubishi UFJ Financial Group. This will give Bancorp a better presence on the West Coast. Then there are higher interest rates, giving bigger consumer-focused banks like the US more leverage. Higher interest rates, a better branch network and a low starting valuation make USB stock a winner for 2023. The stock yield is 4.3%. Number 6, Canadian Natural Resources Limited. Canadian Natural Resources is one of Canada's largest oil companies. With its roots in Alberta, it began developing reserves of near-surface natural gas in 1989 and heavy oil in 1993. Over the decades, Canadian Natural consolidated its land holdings in Alberta and acquired an increasing number of oil sands projects. These reserves have enormous value today. This is because the oil sands operate more like traditional mining than oil wells. Once a property is built, it will operate for years, even decades, without a significant drop in production. This is useful in a world where environmental regulations make it difficult to build new oil projects. Add to that Russia's invasion of Ukraine and Canada's natural resource reserves become even more strategic. The shares trade at around 8 times forward earnings, with a dividend yield of 4.5%. Before getting into the top 5, please drop a like on this video and don't forget to subscribe to the channel so you won't miss any new update. Number 5, Walgreens Boots Alliance Incorporated. Walgreens Boots Alliance is one of the leading pharmacy chains in the United States. The company has been in the doldrums in recent years, but 2020 has experienced a new round of excitement. The Walgreens location has become critical in delivering pharmaceuticals and consumer products to help manage the COVID-19 pandemic. However, that catalyst has now passed, and Walgreens stock is headed down again in 2022. Long-term concerns such as the threat of Amazon Incorporated could disrupt Walgreens' business. Also, in an increasingly digital world, profit margins in the convenience store business are likely to shrink. However, investors appear to be overly negative here. Walgreens sells for just 9 times forward earnings while still offering a 4.7% dividend yield. Pharmacies are unlikely to be completely replaced by the internet, given strict regulations for selling medicines online and patients who want face-to-face contact with pharmacists. Number 4, Coca-Cola Femsa. Coca-Cola Femsa is one of the largest bottlers of the Coca-Cola Company. Coca-Cola Femsa primarily serves the Mexican market, but also operates in several South American countries, including Brazil. In particular, Femsa is the only bottler in the Venezuelan market. That's not worth much in recent years due to Venezuela's economic collapse. But that should change. The US is now easing sanctions on Venezuela and allowing it to export oil again. This will return Femsa's operations in Venezuela to profitability and bring 30 million consumers back to the soft drink market. With the Venezuelan economy on the verge of reopening, Femsa could be one of the biggest winners among NYSE-listed companies. Even before that, the share of KOF was attractive. Shares trade at about 14 times forward earnings, yield 4.1% and benefit from an improving economic outlook in Mexico. Number 3, Stanley Black & Decker Incorporated. Stanley Black & Decker is a leading manufacturer of power tools, outdoor machinery and industrial fasteners. In 2020 and 2021, during the pandemic period, people renovated their homes and beautified their gardens, and the company ushered in unprecedented prosperity. However, demand has flattened as the economy reopens. Tools are durable goods, which means that someone who bought a gadget recently is unlikely to buy them from Stanley Black & Decker for a long time. Long story short, the company's earnings fell from record highs to well below normal levels in a matter of months. In the long run, however, earnings should normalize. In the years leading up to 2020, the company has typically averaged around $6.50 in EPS. Pricing Stanley Black & Decker at 17 times forward earnings from normalized earnings yields a stock price of $110.50, a far cry from its December 13 closing price of $82.79. Equities returned 3.9%. Number 2, New York Community Bancorp, Incorporated. New York Community Bancorp is a large regional bank serving the greater New York area. Over the years, the bank has grown by serving a niche market, multifamily loans. The bank is the primary source of financing for homeowners in New York. This type of loan offers moderate returns but has extremely low risk over the years due to the stability of the rental and housing market in New York. As proof, even in 2008, when many banks were failing, the New York Community Bancorp remained profitable and kept its dividend stable. The company recently received final approval for its merger with Flagstar Bancorp, which closed on December 1st. This paves the way for substantial earnings growth for the combined company over the next few years. Currently, the shares are trading at less than 8 times forward earnings and have a dividend yield of 7.6%. Number 1, Grupo Aeroportuario del Pacífico. As its name suggests, Pacific Airport Group is a Mexican airport operator. It holds concessions for 12 airports in Mexico and 2 in Jamaica. The Mexican airport concession runs until 2048 and includes automatic inflation adjustments. Major concessions include the metropolitan city of Guadalajara, the industrial hub of Tijuana, and several tourist destinations such as Puerto Vallarta and Cabos. Mexico has maintained some of the lightest COVID-19 travel restrictions in the United States, fueling a tourism boom. Passenger traffic reached pre-pandemic levels in late 2021 and continued to increase. In November 2022, Pacífico reported 22% more foot traffic than the same month in 2019. The company also cut costs during the pandemic, which means it is now making record profits. Pacífico has a variable dividend policy, paying out the majority of its free cash flow generation in the form of dividends each year. The title is currently yielding 4.7%. This concludes our list of 15 best dividend stocks to buy for those who are willing to go for the long run. Investors should consider dividend stocks as they are a long-term investment with a fixed return. Dividend stocks are a long-term investment, so they should be held for at least 5 years. And it is important to have a diversified portfolio of stocks and not just focus on one market. Thank you for watching the video. I really hope you liked it and you find it helpful. Tell us in the comments section which is your favorite dividend stock, especially if it is not on this list. It will allow the whole community to discover it and maybe invest in it.